It's no surprise to say I'm most focused on the Fed meeting on Wednesday, but a precursor to that being Tuesday's CPI data. So, I think everybody pretty much knows that the Fed will be raising rates by 50 basis points. And at the same time, ECB and the Bank of England will be raising rates by possibly a similar amounts. What is unknown is what kind of tone will be taken with the Fed statement combined with the press conference from Chair Powell. On the day of the press conference, the market has risen an average of 3% in that single day. So we could get a big surprise again this week as well.
What would the surprises look like? In other words, we go 75 basis points, 0.75%. And no indication of a slowdown, the market's tank. Like, lay out the scenarios.
Well, right now, when we look at last week, we had all sizes, all styles, all sectors in the S&P 1500 in negative territory, along with 96% of the near 150 sub-industries. So you have a lot of people who are just bailing out in anticipation of this meeting. So I think a lot of negative news has already built in. If the Fed comes out and pretty much tells us what we already know, I think investors will breathe a sigh of relief. I think that we're going to get dot plots that come up to about the 5% terminal rate from the lower middling 4% area. So that's probably not going to be a surprise either. I think that if we get some sort of statements that imply that, yes, a recession is around the corner and we don't really care how deep it's going to be, we're going to bring inflation down to 2%, that could end up causing much more concern than anticipated.
Does the Tuesday CPI number matter, or do you think the Federal Reserve has already made up its mind?
Well, certainly last week's PPI number mattered. So I think that the CPI number will matter to investors. It probably won't matter to the Fed voting members, because they probably had advance notice of that information. Also, they're looking at forward data. Our expectation is that they'll raise by 50 basis points in February, another 25 in March, and then hit the pause button for at least 6 months before thinking about, let alone communicating, the potential for the start of a rate easing process.
You're kind of singing to me here, Sam, because did you just say that we might have a Federal Reserve that kind of goes off the radar for half a year? I mean, is this Christmas come early?
That's right. Well, you're tired. You're exhausted. I'm singing to you. You'll fall asleep before the show is over. But could be a lullaby, if you will, from the Fed saying we've done our job. We don't want to overdo it because basically the target we're aiming at is on the other side of the horizon. So we don't want to overdo it. So I think that the Fed will press the pause button after the March rate tightening and take a wait and see attitude.
Why does it seem like everybody's so doggone negative for next year? We're starting to see some of the, your competitors and others are rolling out their forecasts. And by the way, if you've got one, let us know. But I haven't seen anybody bullish next year.
Well, our target is 45.75, which is a 16% advance from where we are today. I come up with that number based on technicals as well as the cap-weighted target price differential by CFRA equity analysts, and obviously we cover all the stocks in the S&P 500. And our belief is, a lot of people are simply forecasting recency. We are down by double digits so far this year, and only twice in two bear markets since World War II did we have that second year, that being 2000 as well as 2001, and then in 1973-74. So basically the market rises an average of 70% of the time the year after a double-digit decline and is up an average of 8.5%. And too many people are forecasting recency and basically saying next year will be the same as this year. It will only if we end up falling into a mega meltdown bear market.